Hello to everyone, and welcome to today's webinar on the five hottest stocks to trade during the pandemic. Thank you for making the time to be here today. Do note that we are going to run a live Q&A at the end of the webinar. If there is time, you can understand that it's a bit squeezed for an hour because there is so much to talk about here today. But do not worry about this. We'll get you covered. We will send you the recording when it becomes, of course, available. Now, today, I did decide to bring some enforcements due to the complexity of the topic. So we will be joined by our esteemed invested research team members, David, he's on the left side, and Daniel, who is right in the middle. My face on the right, and as you can say, if you're familiar with our marketing size videos. Now, David is passionate about helping everyday investors make informed trading decisions, and he will help you understand the ins and outs of the stock markets before we go into the finance stuff that Daniel has been crunching for quite a while now. Daniel has over a decade experience in equities research and trading, and he'll be helping us demystify the complicated world of research. Me, on the other side, I'll cover the technical part. I'll be identifying some patterns and some levels to take into consideration when the time to trade, of course, comes, right? Now, I've seen a lot of predictions over the years, mainly on social media. And over the past few months, since the pandemic started, actually, we are really seeing a lot of predictions. Now, everybody's becoming an expert. But we haven't really been able, I haven't been able, at least to see any analysis or research backing those posts, right? The expert posts. It's just text with no backing. So today, we're going to show you how we can identify hot stocks and how to trade hot stocks based on professional grade research and analysis. So just to break it down for you, let's have a quick look at today's agenda first. Then I'm going to read your risk disclaimer, and then I'm going to pass it over to David. So first of all, as I said, David is going to do the first few parts about the stock market history, the types of markets, secondary, primary, what is a stock, the types of stocks, how we can invest in stocks, and what are really stock CFDs, because retail traders, as yourself and myself as well, we can only trade stock CFDs through an FX broker. And now, then again, how to invest like a pro. Then, of course, Daniel is going to take over with his equity research analysis. He's going to go into details about how he's analyzing which stocks are particularly hot, and then I'll take over with my favorite Elliot Wave analysis, of course. Now, before we start, though, I need to quickly read your risk disclaimer, and then we'll be all set to go. Foreign exchange trading and investment in derivatives can be highly speculative and may result in loss as well as profits. Foreign exchange and derivatives trading is not suitable for many members of the public, and only risk capital should be applied. The webinar is provided for information purposes only. No information contained herein constitutes solicitation for the purpose of the purchase or sale of any commodity, security, or investment, nor should it serve as the basis for an investment decision. Orbex Limited does not guarantee the accuracy or completeness of any information or analysis supplied. Now, and as I said, I will be unmuting David here. I will bring him over as well so you can see his face. And David, thank you very much, of course, for making time to participate in this webinar. Your support is very well appreciated. And I will just leave you with it now to just do your part for this amazing webinar that we're hosting here today.
Thank you, Stavros, for that introduction. Yes, hello, welcome to those that have joined us today. Thank you for your time. So as the webinar is going, it's a brief history of the stock market I want to take you through in the beginning. So the stock trading started in the 1700s in the US. It actually started before that in the 1600s in Europe, but we'll focus on the New York Stock Exchange and the European indices, and European stocks at the moment. So up until 1982, stocks remained a high-risk game until futures trading was born. And then as a result, a new era of speculation began, and this is what I want to look at more specifically today is the speculation. So as we go on to the next slide, just bear with me. Okay, so continuing this, so traditional stocks up until a certain point were mainly used, certificates of deposits, bond stocks, ETFs. But as I said, the speculative vehicle is what I want to focus on today. So electronic trading, as you are probably aware, if you have a device anywhere in the world, you can trade on the stock market. As long as you have connection to a MT4 platform, you can trade on the stock. So, and this is based on margin trading, which is something I want to touch on a little bit later in the presentation as we go through. So first of all, we've got it all started out with initial public offerings and season equity offerings. So initial public offering IPOs, first time issuance of shares to raise capital. This is basically, company A wanting to raise capital to open a company to make sure it's got a sufficient amount of funds, maybe to get through the first year, and then obviously grow as it goes on. And the second part is, if it's a company that is actually well established, it can actually still put in an SEO in order to raise further equity. So this diagram here is just to quickly show you, we've got the IPO. The company issues the assets, it's made available to the primary market, and then it's made available to brokers, and then it's passed on to normal traders to buy and invest capital in that firm. Then we've got the secondary market where investors purchase old issued stocks, so not directly dealing with the companies. So it's not centralized basically. So we've got the broker market and the dealer market. So again, just a little diagram to show you that the IPO, the asset is released into the market. The brokers provide it to the retail market and then onto the MT4 platform, which is where the general trader can actually buy and sell the speculative price of this share, which is important as an over-the-counter product. So as I say, we'll touch on that just shortly. So what is actually a stock then? So it represents an ownership in the firm back in the day where you would actually go and purchase a percentage of that company. So we've just done a small example here. Company ABC issues 100,000 shares at $1 per share. So if you buy 1,000 shares at $1, you own 1,000 of that company, and it will be 1% of the company's capital. Stockholders can earn a return in two ways. First of all, the price rises over a certain amount of time. So you buy your stock at $2 per share, your capital is now worth $2,000 as opposed to $1,000 because it's doubled in price from $1 to $2. If it triples in price, then the formula will go onwards and upwards depending on the profitability of the company. And the second of all is the dividends are paid to the stockholders. So dividends are usually paid quarterly, so 4 times a year. And it's a way of the company, based on the profitability, giving something back to the investors. So ABC pays 25 cents in dividends per year. So the dividend payout based on the above example will be $250. So, what are types of stocks? So there's a few types of stock, like your blue chip income stock, cyclicals, growth, and the list goes on and on. So there are certain stocks that traders can invest in, that you can invest in as well, depending on your own performance and your own lifestyle choices. So let's say like cyclicals, for example, they're tied to performances. So, the automobile industry, the manufacturing industry, retailers, clothing stores. So when the economy is doing very well, these certain types of stocks seem to go with the trend as well, because more people have got more money to spend, a lot more disposable income as well. So, if you want a new car, it's a lot more easier to make that decision rather than, unfortunately, as the economy is in now, in a bit of a downturn, than it is to buy a car, make that easy decision. Growth stocks as well are important. You've got, off the top of my head, Facebook, Tesla, Amazon. These stocks, excuse me, have been forever kind of soaring, especially this year, going to record highs. So these are important stocks to look at as well. You've got defensive stocks, these are immune to economic performance. So no matter if there's an economic downturn, a recession, grocery stores still have to, still will have a profitability. We've seen when the lockdown started across the world, I think grocery stores were probably the ones that made the most profit at the time, because obviously everyone was panic buying and, the shelves were empty with grocery items. So this is an important thing to take into account. Even though there's an economic downturn, maybe a recession, these kind of stocks are still going to be profitable. And speculative stocks, these are good with short-term potential, but they are quite risky. So you have to manage your risk on that. So how can you invest in stocks? So like I said in the previous slide, the best thing you can do is pick a stock you want to invest in after analyzing the market. So it could be based on your own personal circumstances. If you're in the airline industry, if you're in the retail industry, you might favor these kind of stocks more than, let's say, the banking industry, where you might not have so much knowledge about it. But, you know, banks have been in the news recently, so it's a very good time to analyze. You have a lot more information in the news and on the internet about these things that you can invest in as well. So it's very, very important to do something that relates to yourself. Also set a budget for your investment. Obviously, you know, we've heard stories in the past where people have gone over budget on things and they've been trying to claw their way back. So, you know, if their drawdown has been over 50%, it's very hard to get back 50% of your equity if you've lost it. So basically, do not lose what you cannot afford to. Create a nice portfolio for yourself. Don't put all your eggs in one basket. Make sure that you are mixing things up a bit. So your portfolio is a lot more dynamic and it's a lot more interesting as well. So you're not just going to the banking sector or the pharmaceutical sector. You're going to different sectors as well that you can get a lot more back from it. And also find a regulated broker with low commissions, good spreads, and fast execution. There is a slight typo in that sentence because we do not have commissions. We offer no commissions, but every broker will say it's got good spreads and fast execution. But it's important to build up a trust with these with the broker that you're dealing with, which brings me on to point 5: open the account and learn about the product before investing money. So you have to be able to have a good relationship with your broker, with the person that you're going to be dealing with, and to make sure you're getting the best bang for your buck, let's say, and getting the best out of what you can when investing into the financial markets. And then monitor your performance and diversify. So that brings kind of back to point 3, where you're diversifying your portfolio, making sure you're not putting all your eggs into one basket, and making sure you're getting the best out of your portfolio as possible. So moving on to what are actually contracts for difference, CFDs. We hear the word all the time, but what actually are they? So they create buying as well as selling investment opportunities. So, like we touched upon in the first slide, a lot of the shares back in the day, you'd buy them and you'd sell them for a profit, hopefully, or a loss. With CFDs, you can actually profit on a company's stock going down if you open a sell position. So it works in both buy and sell environments. Unlike the share market, investors take no ownership of the product. So like we said before, it's a speculative price. So if you were to buy a share of a company a long time ago, you'd own that, as I gave the example in the other slide, you'd own that $1,000 worth of shares. But here you're trading on a speculative price. So if company ABC's price is speculative at $100, it rises to $150, you close the position at a buy price, a buy trade, then you're going to realize a profit. However, if the roles are reversed, you would lose that amount of money you've invested. So it's just a case of understanding that you're taking no ownership in the product itself. So they're trading on leverage and margin, which we'll just touch upon shortly. And then due to their high volatility, CFDs have a lower leverage than currency trading. And stock CFDs are trading during the New York session hours. These are for American stocks, and European stocks are obviously in the European session as well. Just to touch upon as well that with larger profits can come larger gains when trading. So we just have to be careful. So I've just got a bit of an example now on a Santander trade that I opened a few days ago last week. So I'm just going to get the calculator up just to make sure that it's very easy to understand. So what I've done is I've opened a trade at 1.63 and I wanted to put a stop loss in. So the stop loss that I've done is just a little bit what I think based on the trend of Santander is where I want it to be. So what I want to do is not risk more than 1% of my capital, of my balance. So my balance at the moment is just before the trade was 25,000. So 1% of 25,000 is 250. So that's the most I want to risk for this particular trade. So if we do 250, so it's just a little bit slow. So 250. So that's basically what my 1% is. So what I've done is the way we can measure how much 250 is away from my open price is we just have to, the open price is 1.63. And then we minus that by the distance from the open price to the stop loss, which my stop loss was 97, I believe. Yes. So that leaves me to 66 cents. So what I need to do now is divide the 250 divided by 66 cents, which gives me 378. And that 378 represents the lot amount that I've opened here. So basically, I needed 378 lots to open from here to here for the 250 to take effect on my stop loss. And on the flip side of that, I just want to take you through the take profit as well. So what I want to do is realize a 2-to-1 ratio on the take profit, because if we do less than 2-to-1, then you're not really getting much out of a return. So if the one is a stop loss, then we want at least it to be double or close to double, so we get a little bit more of a return. So what we need to do on that sense is the 163 opening price, we need to actually minus that from the take profit, which is 292. So I've done it the other way around, but it equates to 128. And then what I need to do now is take that 128 and divide it by the the distance from the open price to the stop loss, which is 67 cents. So divide 67. And that will give me 1.91. Now we said we want it as close to 2-to-1 ratio as we can. I've got 1.91, which is a decent, it's a decent risk reward. So I'm happy with that. And I did the take profit based on the recent gap that we've had from the downturn in the when the pandemic started. So I'm believing that it's going to go up, and I'm happy to kind of put a take profit on the last leg of the downside. So this is what I want to do. So I want to take that 191 now and multiply it by the 1%. Which equals to 477. Then I just need to multiply that by the entry price distance to the take profit, and that will give me 611. Now this 611 represents how much money I will make if my take profit is hit. So it's just a couple of calculations to take into consideration when you're risking that 1% or even 2%, even up to 5% of your account, however your risk reward ratio, however you want it to be. And this, based on the targets that I have, as I said, this is the downturn. I'm believing now it's finding a little bit of support here, and I want to return it back up. I'm expecting it to return back up to this amount. So I want to put a take profit here. So this is based on my own general outlook of the market. So yours may be different, but with the calculations, we can really see what it's going to be like. So, and just finally, before I hand over to Daniel, so how to invest like a pro. So there's a couple of things just to look at. So fundamental analysis, technical analysis. Your fundamentals are basically, what's coming out of the market based on the stock itself. So we've got earnings season at the moment, which is a very good example on how a company has been trading in the last quarter. If we just take a quick example of Apple, last week it had a iPhone 12 event that on Tuesday, and actually the share price went down on the announcement. Now, why is this? It's not because of innovation. It's because of the fact that Apple didn't give so many updates, and it gave the 5G connectivity possibility. But apart from that, there wasn't anything for investors to really sink their teeth into. So then share prices went down. So it's important to understand that even though such a big company is releasing another product, it's not necessarily the case that the price of the share will actually go up. So this is something very important to take into account. And then your technical analysis, finally, this is just making sure that your own style, your own patterns of trading, maybe you work in the evening, maybe you work in the morning, in the daytime, you have different hours of trading. If you're a European trader, the American market might be more beneficial to you because you have more time to focus on it. So there's certain things that you can look at in that point of view. So that's all from me. I'll hand it over to Daniel now. So thank you very much for joining me on this on my part, and I hope you enjoy the rest of the presentation. Thank you very much.
Thank you, David. That has been very useful to have a look at how this 1% example is calculated. I'm pretty sure many retail traders will find it very, very, very useful. It's been an interesting few slides. And now what I want to do quickly is just give control to Daniel. Hold on 1 second. And just to make sure that Daniel can take over, let me unmute him as well.
Oh, there it is.
Hey, Daniel. There he is. Daniel, so yeah, David has actually brought us to where you are taking over. I assume you're going to talk to us about value trading, basic valuation tools, and it's pretty much you're just going to show us how you crunch your numbers. And then once you're done, I will be taking over for, to see whether we have a match on the patterns and the technical analysis. So off to you, and I'll be taking over very shortly.
Well, thanks, Stavros, and hi, everyone. I hope you're enjoying the webinar so far. So my point is to talk about how you could potentially look at stocks and figure out whether a stock that you might be interested in is a good investment or not. So let's see if I can move this down. Okay, so a lot of people think that when you're going to trade in stocks, you need to figure out something that no one else knows, and they'll give you some special insight to buy a stock, and then it'll go to the stratosphere, and then you'll make a bunch of money. And that does happen. It's sort of like the model of Michael Burry, for example, which became famous because they made a movie about him. But the actual investment is easier, but maybe a little bit more complicated than that. Sort of following the model of Warren Buffett, which is the sort of value investment model. So the thing is, most people, when they're trading, they're going to be trading blue chip stocks. The thing about blue chip stocks is that everyone is trading them, so everyone is following them, and there are these major hedge funds and investment banks who are looking for every little bit of information potentially that can move the stock out there. And so, I mean, like I said, it's possible for you to have some information that they don't have, but it's not exactly the best investment strategy. So the thing is, you can use the same information that all these hedge funds have to calculate whether a stock is a good investment or not. And you can actually make the same calculations that they do and have the same evaluation that they do using a few relatively simple calculations using the information that's there. And this is sort of the difference between when you're doing value trading between what we might call objective evaluations of a company and subjective valuations of the company. So what we have is basically stocks move on two components. One is the objective value of the stock, which is based on the information that usually the company provides through its quarterly reports. And this is what everyone looks at, and then they can make an estimate, an evaluation of how much the company is going to be worth from an objective standpoint. Everyone's going to look at the same data, and they're going to come to the same conclusions. And this is going to generally provide a trend for the stock. So you get the company will report its quarterly earnings, and this generally will provide a trend for those earnings over the next 3 months until the next report comes out. But the stock will go up and down in between. And this is because people are making different subjective decisions along the time about maybe this is a good time for them to invest. Maybe it's a good time to invest in 2 weeks from now, right? So that's the general dynamic of blue chip stocks where there's a lot of people that are following them. So we can use an example of this, as a matter of fact. Okay, so as a simple example of the difference between objective valuations and subjective valuations, we can look at a comparison between General Motors, Ford, and Tesla back in 2016. Well, we can see that, General Motors, compare General Motors and Ford, the first two columns there on the left and the right. On the left, we have how much the market capitalization is, how much the company is worth, basically. And on the right, we have the number of sales. And we see that General Motors sold more cars than Ford. Consequently, as a company that's selling more cars, it should be worth more money. But then we look at Fiat Chrysler, that company is making a little bit less, is selling a little bit less sales than Ford, but its market cap is significantly less. Why? Because there are other factors that come into play. But the really big difference we notice is Tesla. Tesla has a significantly high market valuation. People think it's worth a lot of money, but it isn't selling very many cars. And why is that? It's because the subjective evaluation of people expecting Tesla to be worth a lot of money because they're developing a new technology. Electric vehicles are expected to be a big thing in the future. And so that is pushing the price of the stock higher. One of the factors is pushing the price of the stock higher, which is different than from the objective valuation based solely on the amount of sales that it has and the amount of profitability it has. The key things that you need to have, there's basically four components that are the basic ones that everyone needs to know when they're evaluating whether a stock is a good idea to invest in that. So that's the price earnings ratio, the earnings per share, the dividend yield, and the return on the investment. So we'll start with the earnings per share is basically how much profit the company has per unit of stock. And so the thing is, when you buy stock, you're not buying the entire company. So you really don't need to, it's not as useful for you to know how much money the company's making as a whole versus how much money the company is making as your portion of the company. So if you own 3 stocks, a share in the company, you want to know how much profit corresponds to you as the shareholder owner, right? And that's what the earnings per share is. Basically, it's the net income of the company divided by the total number of shares outstanding. The second element is the price earnings ratio, and that is basically how much the company is worth divided by how much profit it's making. So this will tell you how much or how long it will take you as an investor in that company to make your money back after you invested in it, right? Now, again, you don't care about the entire company because you're not such a billionaire that you can buy the entire company, but you can buy shares. And so what you want to divide that is the share price divided by the earnings per share, right? And so this helps you to determine whether a company might be overvalued or undervalued. So if the company is the price of the stock is really high and their profit is relatively low, this can tell you that the company is overvalued and the price of the stock might go down. Or if you have a large earnings per share and a relatively low stock price, in other words, the PE ratio is relatively small, this means the company is potentially undervalued and it might be a good thing for you to buy. Right. But the thing is, companies don't distribute all their profits to their shareholders. They need to keep some of the money back from their profits. They need to keep some of it back for future investments, to save for a rainy day, to pay other things that they might need to do. And so only a portion of their profits are paid out to the shareholders in the form of a dividend. Usually it's about anywhere between 40 to 60%. Most companies will pay out of their profits to their shareholders. And that's how much money you as a shareholder would actually make in the company. And so what you want to calculate is the dividend yield on that, which is basically the stock price, how much money the company makes divided by the stock price, and then you multiply that by 100, and it gives you a percentage, right? So a dividend yield is a certain percentage of the amount of money that you would get on that stock if you were to buy it at a particular point. The stock price keeps changing, so of course the dividend yield keeps changing. So if the stock price is worth say $100 and the dividend is $1.25, and then the dividend is paid quarterly, so that means you get $5 each year for that $100 investment. So the dividend yield is going to be 5%, right? You're going, for every $100 that you buy in that company, you could potentially get back 5% in dividend. Now, if you're doing CFDs, this isn't something that you have to worry about in the sense that you're not taking possession of the stock, so you don't get the dividend. But it is something that drives the people who are buying the stock, and that can change the valuation of the stock. So it's something that even if you're trading CFDs, you still want to pay attention to the dividend yield. And then finally, we have the return on investment, which is the whole thing that we're really interested in, is how much money you're actually going to make on the company if you invest in it. And so you can calculate retrospectively the return on investment is, for example, you look up the earnings report from the prior quarter and then the current quarter, and then you see how much the stock price moved and how much dividend they had, and then you can see how much a person owning that stock would have made in that period. And then you can also then make an estimate of how much you, from here to the next quarter or the next period when you plan to exit your trade, how much money you would potentially make. And then this can then allow you to consider what's your potential return on investment in one company, and then what's your potential return on investment in another company, and then you can decide between the two which one is the best investment. And then finally, what you need to pay attention to is, of course, the guidance. The guidance is given out, most companies give out guidance with their quarterly report. Every 3 months, either the CEO or in the report itself will say, well, we expect to make a certain amount of money in the next quarter or in the next year. And who better to know how much money the company is making or what their financial situation is the company itself. So if you want to know what potentially their earnings are going to be next quarter or next year, you want to pay attention to what the company itself is telling you. Right. So now I've been talking about the earnings all this time. So since earnings are basically they're basically what we call, what could be like a snapshot's the word I was looking for. They're a snapshot each 3 months of what the condition of the company is, and then from there it's expected to trend on the basis of that report. So you probably want to be familiarized with how an earnings report works. And so the thing about these earnings reports is they're like 60, 100 pages long. You're not going to be able to read every one of them for every single company. But so what you can do is pick out like the important key information from each one of these reports. And so there's basically 5 things that you need to pay attention to from the earnings report to get a good evaluation of how the company is doing right now and potentially how it could be doing in the future. And then this could be to give you some indication of where the stock is going. Okay, so as we already talked about, first is the earnings per share. Then of course, revenue, which is how much money the company has been selling. You want to keep track of this over a period of time. Is their earnings per share going up? Is their profitability going up? Are their sales going up? Are their sales going down? Guidance, and the fact that I mentioned guidance twice here should be an indication of how important it is. And then what we want to also focus on is a metric. A metric is one of the ratios or a particular key data point that the company gives out that's related to that company's activities. And then finally, we have the CEO comment. The CEO comment generally is kind of fluffy. It's like the CEO is telling how awesome his company is and why you should invest in the company. But sometimes the CEO will give you some information about a particular issue that the company is dealing with, and that's why it's important to pay attention to. So let's try to apply some of this and talk about the five potential stocks that could be on the move during the pandemic. So we'll start out with Tesla. The thing about Tesla is that it moves mostly on market expectations, where people expect the stock to be in the future, not so much based on its valuation of its price now, right? Because as I mentioned this in the at the beginning, where we had an example of their sales versus how much revenue they have, right? Tesla currently is the most valuable. It has the largest market cap of any car company. It's generally it's Toyota and Volkswagen who are competing to be the largest car manufacturer in the world, and Tesla has a larger market cap than they do, but they only produce a fraction of the cars. So what's driving the stock price? It isn't the fundamentals of the value of Tesla's car sales right now. It's on the basis of where people expect car sales to be in the future. So this is why we can call it a speculative stock, where people are speculating where the stock price will be in the future, and so they're investing in it. But then this also tells us how the stock was likely to move is based on deliveries, because in order to meet those expectations, their current stock price is saying that they're going to be the largest manufacturer of cars, they have to increase their sales to meet that expectation in order to maintain that stock price. So what we need to be focusing on is deliveries, and new product launches, because if the car is too expensive, then there's less potential customers for the car. Well, Elon Musk, a couple of weeks ago, he promised to have a sub $30,000 car in 2 years, but he also promised that way back in 2018, so 2 years ago, and we still haven't. So generally, Elon Musk tends to promise things coming in the future, and they take a little bit longer than he says, right? So the other thing that we want to pay attention to with Tesla, and in this works a bit as a proxy for other tech stocks, is the importance of cheap money, right? So here we have in the back the chart of Tesla, and so what we see here at the start of 2020, we see the stock going up, and then it goes down because of the influence of COVID comes out, and then we see this massive increase in the stock price where it goes up about 10 times. And where does this massive increase of stock price over less than a year? It isn't because Tesla is increased their production by 10 times. What happened is basically, there's more factors to it, but to super simplify it, is that the Federal Reserve in particular and other central banks reduced the interest rate, and they started quantitative easing, making lots of liquidity become available so that it was a lot easier for people to buy stocks on margin. So there's an expectation that Tesla's stock is going to be worth a lot in the future, so people are buying it with cheap money. Next, we have, speaking of tech stocks, next we have Oracle. Now, Oracle has, well, it benefited, of course, from COVID because Oracle provides basic IT services. But Oracle in particular is something to pay attention to aside from all the other ones because they're the final bidders for TikTok. And TikTok is this massive social media platform that could potentially be as big as Twitter and Facebook, or it could potentially be the next Vine. Who remembers Vine, right? So it's still... it could move it most likely definitely will be moving the stock in the future. It has a lot of complicated moving parts because it involves different geopolitical deals between the United States and China. So it's something that could create increased volatility depending on what the State Department of the United States does, what the Chinese government does, and the negotiations are still on. So so if you're interested in a stock that's likely to be moving around quite a bit, Oracle might be a good option for that. The things that we want to pay attention to, of course, are the result of TikTok, what their user metrics are, whether they're increasing the number of people that are using TikTok or the number of people are going down. What about other platforms that are competing with it? We have Instagram coming out with a competing model. Are people just going to stick with Instagram and not have two social media programs? You know, that's something to pay attention to. And then, of course, Oracle, in their latest report, did not update their guidance, including the TikTok deal. So we don't know how much even Oracle expects TikTok to influence their earnings. So at the next report, they're likely to tell the market how much they expect the Oracle deal to influence their earnings, and that could also move the stock. So it's something else to pay attention to. Moving on, we have another interesting industrial company is Boeing, which might not be the most obvious choice considering how much air travel has been restricted because of COVID. But that's actually kind of the point, because air travel has been restricted. The price of Boeing stock has gone down significantly because of that. But air travel is likely to resume at some point. We might not know exactly when, but it's likely to. People are going to return to traveling. Airlines are going to need to renew their aircraft, and there's a particular thing about Boeing is their 737 MAX. Because one, it's been having this long-standing problem, which is likely to be resolved relatively soon. Just last week, the European regulatory agency was flying on the plane. They said it was looking good, and then earlier in the month, it was actually, as a matter of fact, the FAA also was on the plane saying that it's likely to be certified relatively soon. We don't know exactly when, but when it does, we could expect the stock price to move significantly higher because the 737 is one of the key money makers for Boeing. Then we also had the recent news that they're moving this 787 manufacturing to South Carolina from Seattle. South Carolina is cheaper manufacturing than in Seattle because of different regulatory reasons. And so they're using the situation of COVID to take advantage of restructuring their facilities to be more efficient, and that can also help improve their profitability going forward. And then finally, we have the issue of the vaccine, because when we're going to return to the skies is going to depend largely on when there's a vaccine available to give people the assurance that they can start flying again. And so that when the vaccine becomes available, also it's likely to be an important factor in Boeing. And speaking of vaccines, Pfizer is probably the most advanced in terms of getting a vaccine done, which is why we're highlighting Pfizer right now, because one used to be the AstraZeneca Oxford vaccine was the lead candidate, was likely the most one to get finished first, but then they had some difficulties. There were a couple of cases of unidentified people some people got sick for reasons that they weren't clearly identified, so they had to halt their studies for a period of time. This delayed similar competition they have from Johnson & Johnson also recently had to delay their vaccine. So the update, here's a table of like the most the most prominent vaccines for COVID. Pfizer expected to have their efficacy results sometime before the end of the month. But they then still have to review the safety profile, and that, as a matter of fact, on Friday, they announced that by the third week of November, and then when they have their safety profile done, third week of November, they could almost immediately, within a couple of days, they could apply for the emergency use authorization from the FDA, which would mean that it becomes available, and they're already manufacturing this vaccine, so their objective is to have at least 100 million doses available before the end of the year. So third week of November is probably an important date to keep in mind if you're interested in Pfizer and if you're interested in airline stocks also. Since the program is still ongoing, we don't know how much money Pfizer has spent on the program and how much they're going to spend on developing it. So we want to focus on how much the research and development cost for the vaccine has been. And then this will impact potentially how much money they could make on it in the future. So once the emergency of COVID is over, Pfizer will then start charging and potentially making money on the vaccine. And then we have, oh, and this is the other thing that I wanted to mention, is if we look at the stock price, Pfizer hasn't totally recovered to their pre-COVID. Here's the peak just before COVID, and then we had the drop in from the COVID impact. It hasn't totally recovered from COVID. So Pfizer does have, in terms of earning, just in terms of valuation of their stock, it still has potential to grow as well, to return to its pre-COVID level. And then if they get their vaccine out first and they get and it's really efficient and it gets wide recognition, they could end up, their stock could end up going up quite a bit. And finally, we have Banco Santander. And why Santander? Well, generally, we want to pay attention to the banking stocks because, as a general rule, banks tend to be, they don't generate as much profit, but they tend to be relatively safe investments. And during a period of economic turmoil, safe investment is generally a good idea. But why we're focusing particularly on Santander is that they have a pretty diverse portfolio. And what happens during recessions, and particularly in the case of something like COVID, where you have the central bank drops the interest rates. And when interest rates are low, banks don't make as much money. Santander in particular, as a sort of semi-global local bank, they have a fees-based model. They try to make money on the basis of charging fees more than garnering money through interest rates. So they're better positioned than other banks that relied more on interest rates to go through this particular period of time. And then also we have some changes because Santander is based in Spain. It is the largest local bank in Spain, but then their competition is also looking to consolidate. So there's going to be quite a bit of movement in the Spanish market, which can also move Santander's price. But the solidity of Santander is also easier to see because they don't feel the need to merge with other banks. They think that they have the financial backing essentially to continue to function. And one of the reasons that can happen is we can see that they have a different diverse portfolio, and some of their, or significant portion of their portfolio is in better performing areas. So like, for example, of all the major economies, the United States is the one that has been the least impacted by COVID. Their economy is expected to drop the least. So with Santander having a 10% of their investments in the United States, they're more likely to have a better results than other competing banks that have investments in, for example, places like Turkey or Italy. A certain amount of advantage. And then secondly, their exposure to emerging markets. And what happens is that when a recovery manifests itself, we get a move of credit towards places that have higher yield. Brazil and Chile are one of the key targets for that. And of course, something that has a large presence there. And then the other thing that we want to look at, the stock price. We see Santander lost market value because of the COVID crisis, and since then has not recovered. They potentially will. This gives them more potential for upside because a lot of the companies went down and then they rebounded, and so they've recovered from where they were prior to COVID. Whereas something that hasn't done that yet, it gives them more space to bounce to the upside, which is why David's investment there in Santander potentially would be a good idea, at least from the fundamental standpoint. And so I think that's about it. So I can hand it back to Stavros. and so you can give us some.
Daniel, thank you very much for this. You've actually made many, many very good points. And I was just going to touch upon your last one about David's example. It's not just David, it's also my example on Elliot Waves. So we're going to see that
Oh,
very
cool.
shortly, yes, because you guys have taken all of my time. But it's okay. It's all been very, very useful, I'm pretty sure. Thank you very much again.
Yeah, thank you. Awesome. Looking forward to it.
So guys, before we go on the charts, I want to talk to you a little bit, just a tiny bit, two slides about technical analysis and about Elliott waves. Now, as you know, technical analysis is not just we're just going to go use the RSI the same way as this trader does, or I'm going to go use this MACD as the same way as the guy does, or I'm going to follow this guy on Twitter and start trading what he trades. This is not how it works. If you want to be your own trader, you need to start to actually, you will have your own style. I mean, essentially, or eventually. But what I'm saying is that the more you try to separate yourself from others, the more of a trader actually you're going to be. Okay. Now that said, you might be position trader, swing trader, day trader, or you might be scalping, right? That doesn't necessarily mean that because you're not using something that someone else is using, which is correct or effective, that your way is not going to work. You might use different timing indicators. You might use leading, lagging, simply time, or you might just be using price action. When we're talking about timing indicators, we're not just talking particularly about, like the RSI or momentum. We are also talking about economic indicators like GDP data, okay, GDP retail sales, the manufacturing data. Daniel gave us so many examples of micro-related indicators as well, which is the APS, all that stuff. They are showing you where it might be a company, it might be an economy. Where is it heading, right? Now, on the other side, we've also got the technical, the purely technical part, where we'll talk about support, resistance, we'll talk about chart patterns, and I'm going to focus, of course, on Elliott Waves. You probably, if you're watching our marketing insights videos, you probably know I'm a very big fan. But whatever it is your methodology, I'm not trying to tell you that you need to use what I'm using. I'm telling you that whatever it is that you do, it has to include elements of effective systems. Okay, so if you're just going to go with price action on technicals, it's fine, but do not leave that all alone. Okay, combine it with fundamentals. Look at the economy, both the economies of the currency that you're going to trade if it's going to be a currency, but if it's a stock, it's even easier because you can get so much data. Daniel said about 600 pages of a quarterly report. Now, obviously, you're not going to go through all of that, but if you just have a 5-minute look at it, that could definitely help your decision-making ability, okay? Now, regarding Elliott Waves, you probably think this is just something that came out over the past few years, and yeah, Orbex does it, and it's so cool, and yeah, I'm following this guy on Twitter. But I will tell you this, it might be actually known by the retail market like over the past few years, but Elliott Waves is the oldest research-based pattern tool that there is in the markets. 1930s, people started even using it back then. You can even, from today back to 1930, if you get the historical data, you can still apply Elliott Waves and see that we're still moving based on that move, okay? It's not magic, it's just people's psychology, market psychology. Now, with Elliott Waves, you can identify market trends using noticeable repetitive behavioral patterns, okay? And terminal/turning points, these are the reversal points based on the fractal nature of patterns, right? Now, not only has it predicted the 1941 38 turning point, but also it signaled the 34% crash of Black Monday, and it's actually signaling a lot more as we are moving to the next year and to the next quarter, I would say, today, right? For that reason, all the Elliott Waves analysis always have alternative scenarios. And it's not just because, oh, look, he's just showing something else to us because, that he's not really believing in the first scenario. It's not really how it works. The alternative scenario, when we're talking about Elliott Waves, has to do with the fractally behavioral patterns and action on the markets, okay? So Daniel mentioned about Pfizer, for example. End of November is a very good period to keep an eye on. Obviously, if there is no antidote by then, we're not going to see Pfizer going up, are we? So there is a scenario that we're going to explore just in case the Pfizer is going to head down because of that fundamental macro reason, whatever you're going to call it. Well, we will know what this is, and we will know likely how the market is going to move to extend down, okay, in what sort of pattern, okay? That is the reason I'm using Elliot Waves. Now, obviously, this is not the last slide, but what I'm going to do now, I'm just going to quickly take you to my charts. Hold on, let me go on TradingView. And I want to show you what I'm looking at when it comes to Tesla. Tesla has been moving on an upside channel for a while now. This is a wave 5 because it had a false break outside this channel now, right? So what number 3 here means in Latin, the Latin number 3 is wave 3. So then after wave 3, we'll have a wave 4 and a wave 5, which means it's either that we are in wave 4 or we ended wave 4. Right? If we ended wave 4, it means that we had an A, B, C, D, and an E. It's a triangle formation. We broke outside, we're going to move higher, okay, and break outside the ascending channel. This is a very likely scenario for me. But I'm also looking at potentially, because wave E missed that trend line down here, I'm potentially also looking for wave D to be over here, right? Which means this is an ABC, and then we're going to see another ABC for wave E down here. That would extend the triangular formation, okay? And that would get us up here a little bit later. But still, there is more upside. The other scenario, which still indicates more upside because we're waiting for wave 5, is that this is an A, B, and a C pattern. This is going to take us a little bit deeper, okay? And I mean, it is possible that we could get a false break and go down to create a double bottom over here with wave 4, which is very usual in Elliot Waves, but that would be a zigzag scenario most likely, okay? So it would be an A, B, and a C. Now, what I'm looking at here is whether this upside move is going to get us above that level or no. If it doesn't, it's going to be a zigzag, and potentially we're not going to have a fresh low below the 355. If we're going to go up to the previous high, this can turn out to be a standard flat. If we go above an expanded flat, which is going to bring us down here, or a running flat, which is going to bring us around the previous wave C. Okay, so you can see there are many scenarios in play, but the important thing is that all of those scenarios are seeing more upsides after we get the validator signal, which is what I like to call it. Okay. Now jumping on Oracle. Well, very dependent on trade intentions, as Daniel explained before. 1, 2, 3, 4, and 5. Here we are in wave 1. Okay. And this is indicating that there is still a lot more upside to see for Oracle as well. But the question is, have we really finished this correction? I don't think we have, okay, because usually waves 2 are not really lasting that. I mean, it could be a sharp wave 2 and we're going to get an elongated wave 4. This is the rule of alternation. But I really do think, because of the corrective structure of this move over here, that we are still not having wave 2 done. Now, that said, again, we finished 5 with a false break up here, as with Tesla. This is A, B, and I'm waiting for wave C. We've done the 78.6 Fibonacci retracement of this move. For that reason, I believe this is going to be a simple zigzag, okay? Which means, well, wave C can go to the 100 Fibonacci extension of A and B, which is around the 57.58. It would be, there's also chances that we are going to go lower to 161 Fibonacci extension near the 55 level, but I'm not sure this is likely to be the case, because the 161 extension for a simple zigzag is not usually seen as being the case. But in case we do so, then there is also chances that we're going to extend just a tiny bit lower to the 54 cluster. This is the 61.8 Fibonacci extension of wave 1, as well as the 38.2 Fibonacci extension of wave the 31 of wave 1 and the 68 of wave 2 to 3 over here. Yeah. So no, that said, the other scenario could be, that we are also going to go for an ABC flat here. And again, it could be a standard flat, down here, expanded flat, further lower, or running flat, probably to the median regression. And then we're moving up for wave 3. And usually, wave 3 is the most extended wave. Boeing. Well, we've identified, Daniel identified this very big decline during COVID. The upside doesn't look impulsive to me, okay? For that reason, I think we are moving in a W, X, and Y double zigzag, and we're expecting another move to the downside, okay? This is what I see. The other scenario is, of course, that we ended this correction down here, and this is wave 1, 2, 3, 4, and 5. That means this is 1, this is 2, and we're going for 3. But I'm really not really a fan of this one, because wave 2 is really elongated, and it looks to me like this is corrective. Okay, this move looks corrective because we have 1, 2, and 3 rather than a 5. Now that said, WX and Y for X, which means this is an impulse to the upside, or we're going to go to X and Z. So either wave X is a double zigzag, or wave X is going to be a triple zigzag, okay? In either case, we need to pay attention to what happens around 190 if we move up, and 144 if we move lower. Now, 144 is a 61.8 Fibonacci retracement of this move to the upside. So it's a very cool level to start considering long positions. But as I said, my validator would be the 190, okay? Below that, well, the case of a triple zigzag remains real. And then, of course, we're going to go for wave X, okay? And that can take us to the 61.8 Fibonacci extension around 250, or to the 100 Fibonacci extension of waves W and X if we ended the correction at 144. Pfizer has quite a few patterns as well. That is because it remains quite volatile. But let's just have a quick look what we see here. I see this as a correction done in wave 2, right? Similarly, we are moving up either for wave 3 or we're still in wave 2, right? But the important thing is that this is cycle wave 1. So in the long term, we are looking for a big move to the upside, because wave 3, as I said before, is always the longest one. Now, if this is indeed wave 2, we can have an opportunity here. If this is 1, 2, 3, 4, and 5, right, it's going to be a leading diagonal. So from there, we're going to get a move to the downside anywhere between 34 and 32 and start moving higher for wave 3. If this is not the case, which means, well, prices are not going to break above the 39.50, right? It means that this is wave 1, this is A, B, and it's going to turn out like a C. Okay, so it means that we are probably going to start heading lower now, because it's going to be 1, 2, 3, 4, and 5 for wave C, right? So it's going to be an A, B, and a C down here. And again, we're looking at the same levels pretty much, but in that scenario, we are definitely not going to break above the 39.50. But in the other scenario, we are expecting a fresh high, okay? So the other idea I had in mind is that this is a 1, 2, 3, 4. We're going to see a 5 wave here, okay? This would make this still an, this would be the end, right, of this correction. And this would be a multi-structure move to the upside. That would perhaps indicate that we're going to see a correction, but it's going to be shorter correction. And then we're going to move up for minor wave 3, right? So this is a multi-structure bullish, 5-wave bullish impulse to the upside, okay? Which means wave 2 is done here in the intermediate degree. And the least favorite scenario for me is that this is not, it's going to be WX, Y, X, and Z, which is going to be a triple zigzag, and primary cycle wave 2 will come down here. But this is not likely to be the case. But as I said before, if Pfizer fails to break an additoid, and some of the competitors actually does so first, then that scenario would be very real. That's why I've been talking about effective systems. And last, Santander. Like guys, for Santander, I need to go back on the 2 days chart. And I will tell you why. Because this is a W, X, and Y from the 2009 top also, right? Now, this is a combination of, the last wave, wave Y, ends with an ending diagonal. That ending diagonal, you have wave 1, yeah, 2, 3, 4, and 5. We are seeing the trend line here being penetrated. However, we didn't get to the level I was looking for. That's the 171. The 171 is the Fibonacci extension of waves 3 and 4. And then if we go a little bit closer, I'm going to take you down to the 4 hours now. Why I don't think that we have ended with this bearish move to the downside is because I don't see a fifth wave. I still see only a fourth wave being completed, right? And I say that because this is 1, 2, 3, and a 4. This is 5, but this is like, I'll show you if we go closer. This is like 1, 2, 3, 4, and 5. So I'm expecting the 172 to be taken out indeed in order to start considering some upside potential. Now, the real long-term opportunity would be after a break of this trend line, right? So we expect that to break. Then we see some sort of a retest over here, and then we'll move all the way back up. That would be a reversal impulse to the upside, right? But for shorter term scenarios, we can consider the break of this trend line to be, what we've been looking for. So we are moving now towards that line. If we bounce here, we'll move lower. I will be expecting a fresh low. If we don't and we'll break higher, it means that this was indeed wave 5, and this move to the upside is an impulse, a multi-structural impulse that is going to take us to fresh highs. And then I would be expecting wave 4 high to break. That is the 3 euros price, okay? So this could be all from my side as well. If you have any questions and you are seeing the recording right now, feel free to comment. Feel free to even ask direct questions to Daniel, myself, or David, and I will make sure that each one of us will respond to your inquiry.